We were able to raise money when a lot of other firms in New York, Boston, Chicago couldn't raise any money. The fund model works the best. It's the best fundamental model for scale. I got to find deals 50 hours a week and only spend time raising money 10 hours a week. And that's when you know you got to switch to a fund model. Some of these people that called me up feeling sorry for me became my investors. Me and my partners, we launched in 2008. This was the pitch. I had few friends call me, John, how you doing? Doing great, what's going on? I'm talking on the phone. What's going on? And they're like, well, I called you because you're in real estate and we feel really sorry for you. In 2008 and 2009 is not a good time to be in real estate. And my reply on the phone was to them, have you lost your mind? 2008, 9, and 10 are the best time to be in real estate in 80 years. There's never been a time in the last 80 years, in your lifetime, there's never been a better time to be in real estate, 2008, 9, 10, and 11. It's the best. Some of these people that called me up feeling sorry for me became my investors. Watch me. I'm a good money raiser. I raised money that way. I'm not a great money raiser. My partners are better at raising money than I am. But that was the pitch that we really turned the screws and just kind of let people know they were missing out on the greatest opportunity they'd ever seen in their lifetime. And the money started to flow in 2009, 10. Yeah. This is the best time to be in real estate. We do real estate. We're buying and selling real estate. We're buying large real estate. We're doing things that individuals can't do. We're buying very, very large apartment complexes. And you should get in rather than call me and feel sorry for me. Because I don't feel sorry for me. I'm so excited every morning going to work because I know there's times in history when you've got to jump through the window. It's the greatest time in your lifetime to be in real estate. Do you want to put some money in real estate? Then you should put it with us. Come see my team. Come see my partners. Come see how we do it. And you're going to be totally flabbergasted. And they would come and look, come to our investment committee meetings, and bam, they were investors. And these are people that called me or are feeling sorry for us that we were in real estate. You'll have 3 levels. You'll have a credit investor. They have a net worth of $1 million, not including their home. Or they make $200,000 a year, or they make $300,000 a year, including their spouse's income. That's the 1, 2, 3. 1 million net worth, 200,000 income, 300,000 income with their spouse. 1, 2, 3. And there's a couple other things now. If you have a Series 7, you're an accredited investor. If you have a Series 65, you're an accredited investor. If you have a Series 82, you're an accredited investor. Okay. Next level up is a qualified client. And a qualified client has 2.2 million of net worth. And there's some other qualifications, not including their home. And the highest one up is called a qualified purchaser. And they have $5 million of investments, not including their home. Because your home is not an investment. You live there. Okay? Even though it can go up and you can sell it, it's not including an investment. So a qualified purchaser is the highest level in the SEC's definition of the high net worth. And you have $5 million of investments, not net worth. There's a nuance there, but it's a little bit different. But if you're a company and you want to be a qualified purchaser, it's not $5 million of investments. If you're a company, you have to have $25 million of investments to be a company and be considered a qualified purchaser. And there are different regulations on what you can charge these 3 levels on fees and other things as an investment advisor. And so those are the 3 basic levels. A high net worth individual is the easiest person when you're first starting fund to talk to and get an audience with and explain your business thesis. Sometimes in a family office or institution for sure, institutions, you got to understand, these people who run institutions like a huge fireman's pension fund, these guys went to Harvard, they worked on Wall Street for 15, 16 years, now they work for the pension fund. They're conservative. And they're not going to invest in first-time funds. They're not sometimes going to invest in your second fund. They're going to wait till their charter sometimes says, we're an institution, we don't invest in first-time funds. We only invest in third-time funds. We want to see a bunch of fund managers work out their first fund, then go to their second fund. And they're still together making money. And now they're launching a third fund, now we're interested. There's a couple things when you're a fund manager, you assess risk. And The first time fund, guys, they might argue and argue and argue, and then they might break apart in 4 years. But if they, in their second fund, and they argue, and they're still together, and they're starting a third fund, that means they've learned how to problem solve. That means they're still together. That means they've made money in the first fund, they've made money in the second fund, so this pension plan can see track record. Auditable track record, third-party audit track record. Now they're going to launch their third fund. We're interested. I started my first fund in 2004, and me and my partners, we didn't get our first institutional investor until I think 2010. It took us 6 years to get an institution to put money with us. Family office would be the Walmart family. Sam Walton had a bunch of kids. Now they have a bunch of money, and they have a few investment advisors that help them invest their money. And that's the simplest. There's 4 to 16 people in a family or close family, and they come together and use the same resources. Now they don't all invest in the same things usually. Sometimes they do. But you come to a family office and pitch the family office. And again, these investment advisors, these Series 65 people that are sitting there representing this family office do a lot of due diligence, and sometimes they don't invest in first time, sometimes they do. But it's more stringent due diligence on you as a fund than a high net worth individual. And institutions are extremely diligent due diligence, and they can't even fly out to see you. Institution, they don't even fly out to see you unless they know they can give you $30 million. And when they give you $30 million, they're no more than 20% of the whole fund. So they know you have a $120 million fund. They might give you $30 million, and that's their minimum. It costs them a lot of money just to deploy money. Institutions deploy a lot of money. And some institutions deploy $500 million, but they don't want to be the largest investor. So how can you find a fund where I can put $500 million in, and I'm not the largest investor? That's usually not the first fund. That's usually not your second fund. That's usually a third or fourth fund, and that's how institutions work. First fund, lending, real estate. Second fund, lending, real estate. Third fund, no more lending, purchasing properties from banks mostly. My first fund in 2004 was assets under management, AUM. That's the terminology in the fund world, AUM. We were rolling about 10 to 20, sometimes $30 million between all of our investors, debt and equity investors. And so we were rolling it in short-term loans, and that was the first fund. The second fund just got off the ground in 2007, and then the Great Recession hit. And so my third fund, we pivoted, we stayed in real estate, we stopped doing loans on real estate, and in 2008, and really in 9 and 10 and 11, we started purchasing real estate from banks. So my first fund in 2004, we did real estate loans. Myself and my partners had experience for years doing real estate loans. And that's what led us into our first fund and choosing real estate loans as our first fund. I had partners and myself, I knew how to do loans because I did mortgages. So I had a skill set that I knew how to do. I would never have started my first fund and start trying to open dental offices because I don't know how to open a dental office. I would have had 2 or 3 partners that had run dental offices for 15 years. Then I could have done a dental, but I didn't have that skill set. In our partnership, me and my partners, we knew how to lend money on real estate. And so therefore, you have to go with what you have skill sets because those skill sets have to convince an investor to put money with you. So if I tell an investor, I've never ran a dental office and I don't have any prior dentist on my team, I just know I can buy dental offices. I'm not going to get a lot of investors giving me money. But if I tell this guy or lady, high net worth individual, listen, I've been doing loans for these many years. My other partners have been doing loans for this many years. We've actually done some loans. Here's our track record. Would you like to give us money for doing loans? Yes. Oh, we have, and what if I just said, but I have a second fund where we're gonna start buying dental offices, and they'd be like, John, do you have anyone on your team that ever done a dental office? No, they're not gonna give us money. So that's why we went into lending my first fund, because my partners had experience doing real estate loans, and we could prove we had experience, and our investors were confident in our experience to take their money and safely risk mitigate their loans to the industry. I wish I just could have started earlier. I wish someone would have taught me finance when I was in high school and college. I wish someone would have grabbed me by my ears and say, listen, I'm going to teach you how a mortgage works when you're 18 or 19. I'm going to teach you how a bank makes money when I was 16. I wish someone would have taught me finance. I understand there's a lot of divorce rate in the world these days. I understand one of the things is finance. That's why people get divorced. So, hey, learning finance might decrease the worldwide divorce rate if everyone knew finance. So when my kids were growing up and I was driving them to football practice or soccer practice, I had them in the car for 15 minutes or 20 minutes. And I would ask them, you guys know how a bank makes money? And we'd go over that. And I didn't teach them one time. 2 months later, hey, tell me how the bank makes money. Tell me how a mortgage works. And so when my kids went to college and they were staying in dorms with their friends, they told me most of their friends didn't even know what a mortgage was. Some of their friends, their dads were accountants and they didn't even know how banks made money. And they did. And so they were tricked. My boys were tricked into liking finance. Because my theory is, look, if you are good at something, you kind of like it. If you're good at throwing baseballs, you kind of like throwing baseballs. And so what I did with my kids, I kind of tricked them when they were little into liking school. So because I made sure when each one of my kids and grandkids, and not just me on the grandkids, my kids do a great job, but my kids and my wife, when my kids walked into kindergarten, all of my kids could do small math problems and they could read. So therefore, they're good the first day. And they're helping other kids in their class that don't know. So they already feel good about themselves. They like school. Why? Because they're good at it. So if I wanted to trick my kids into liking finance, I just got to make them good at it relative to their peers. And now their peers ask them finance questions, and then they have to go look it up or whatever and come back and say, oh, I know how this works. And that emboldens them that they are kind of an expert in finance. Not an expert, but an expert to their peers, and therefore they kind of like finance. And so that's why I pushed all my kids into the fund model, because of the 14 businesses I started and co-founded. The fund model works the best. It's the best fundamental model of any model. Incs, LLCs, limited partnership, general partnership, I believe is the best model for scale in the United States of America. Syndication is easier to get started. If I come to you and I say, you see this location? This is going to be a dental office. We're going to buy this dental office. You can see the location and you're going to invest directly in the dental office, okay? Or a strip mall or a piece of land. You can see it. So you come on syndication and your name is on title. When you do a fund, you invest into a fund and the fund buys a piece of property or an asset. That's the difference. And so it's easier to raise money when you show people what you're actually buying, as opposed to you're trying to convince them of your skill set to go find great things. So it's a kind of a blind pool. You're putting money in and you're depending upon the skill set. That's the difference. So syndication is an easier way to start. And I think most all people should start in syndication in anything, because it's just an easier way to go. To make the jump is when you're spending all of your time, not all of your time, a majority of your time raising capital. And you don't have enough time to go find the deals and work the deals. And so you say, listen, I can't do this anymore. I can't, every deal I get, go talk to each one investor, see if you want to invest in it. I got to find deals 50 hours a week and only spend time raising money 10 hours a week. I can't do 50-50. And that's when you know you got to switch to a fund model. It just wears you out. We met a bunch of incredible partners that became partners in the December of 2008. And these guys were incredible. They had been doing property management for 15, 20 years across the Western United States. And when we met them, we knew we had to have them in the fund. And so we took the Christmas holiday and a little bit over the holidays, and we rewrote our PPM and LPA, and we relaunched in spring of 2009. And that fund, over the next year and a half or 2 years, we raised $127 million from investors. And that allowed us to go buy $300 million worth of property. Because when we buy a property, we're going to get a mortgage on it. we're going to buy let's say you're going to buy a $10 million apartment complex. Well, you're going to put, $4 million down and you're going to borrow $6 million in a mortgage. So if you have 127 million, or maybe it was 120, it was either 120 million or 127 million in cash, that allows you to go buy about $350 million of, and that was the first really big fund. And that's when I was telling you, when people would call me and say, John, we're sorry you're in the real estate market. And I would say to them, are you crazy? This is the best time. 2008, 9, and 10, 11 is the best time to be in real estate. We were able to raise money when a lot of other firms in New York, Boston, Chicago couldn't raise any money because everyone was hoarding cash, the cash they had. So yeah, that was the first fund that really went incredibly big. So PPM is the private placement memorandum, and LPA is the limited partnership agreement. A PPM is a disclosure document. It's a big document that says all the ways you can lose money. If you invest in this, you can lose money by currency risk. You can lose money by the partners all dying in a bus accident. You can lose money if the market. It's a disclosure document. It discloses everything that you can think about that you can just think about of the investment. The limited partnership agreement, the LPA, is the rules of the limited partner. So a limited partner, which is the passive investors, come into that fund, and these are the rules. This is how we're going to govern, how we're going to split profits, how we're going to, if something goes wrong, how it's going to be handled. That's the limited partnership agreement.